Good morning, live from the Nasdaq market site in Times Square. Welcome to a special edition of Advisory Live. We're powered by Nasdaq IR Insight, and I'm your host, Will Briganti. And joining me today on today's special program about the markets is Managing Director from the Nasdaq Market Intelligence Desk, Chris Dearborn, and Masood Ghazi, a Senior Director from Nasdaq Advisory Services. Gentlemen, thank you for joining us.
Thanks, Will.
All right.
How's it going, Will?
Yeah. So today we've seen some volatile markets today. So obviously yesterday, U.S. markets saw the largest single-day drop in the Dow Jones Industrial Average and a severe intraday drop, upwards of about 1,600 points. Friday's session was also incredibly sharp in terms of a fall. So gentlemen, I'd like to break it down and sort of what happened the last two sessions and get your take on that. So we're turning to our two in-house experts for your insight. Chris, let's start with you. Breakdown for our viewers on sort of what transpired over the last two trading sessions.
Sure. So yesterday was really kind of the culmination of what really started at the beginning of last week. What you've seen in the markets for the past 14, even 16 months, is a significant rise from the low end to the high end, where you've seen 8 1,000-point increases in the Dow Jones Industrial since basically the presidential election, which is kind of unprecedented to have that type of move. And you haven't really had a significant pullback, really profit-taking on any level whatsoever across that point. What we saw the last week or so in 2018 started out with a bang. You saw a significant move up in all the major indexes and all the stocks, whereas all the fundamentals are really still the same. You're seeing a fair amount of companies doing well, but you've had potential tax stimulus coming in, some other very positive items. So why are we having this sell-off? You know, nobody really has said a good reason why.
Right.
So let's talk about what has happened and the reason why. You had volume validates the move. You saw over 11.5 billion shares trade yesterday on the consolidated tape, validating that move downward. Everything was orderly. There was no halts across the board.
Right.
There was no canceled trades. Everything was smooth. What that's telling you is that people were taking profits or some other reasoning, selling stocks into the close, which led to the lower intraday moves. We did rally towards the end, and then this morning we're seeing again renewed volatility in the market. Markets opened down almost 1%, if not a little bit more, rallied up over 1%, and now we're in the red again. So you've seen almost a 2.5 to 3% intraday move already, and it's not even lunchtime.
That's right. Masood, let's get your quick take on what took place the last two sessions.
Yeah, absolutely, Will. So I believe this is long overdue. It's healthy. Markets are supposed to be volatile. It's inherent in the market structure. What we're going through currently at a very high macro level perspective is we're going through what's called the Great Unwind. Over the last 10 years, the Federal Reserve, Bank of Japan, and the ECB bought some $12 trillion of assets. Interest rates have been at rock low bottoms. And we're looking at a reversal of that. So as we are unwinding the big unprecedented monetary policy, obviously the equity markets are taking a shock. To Chris's point, the health of the economy is very strong. We're seeing GDP growth kick back in over and above the historical rates of in and around 3.3, 3.5%. We're seeing wage growth kick back in, and that has jolted the equity markets. So it's kind of ironic because on the one hand, we're seeing good, solid economic growth, but the markets are interpreting that as the end of a loose, unprecedented accommodative monetary policy.
Okay, thank you for that quick breakdown. My next question for Chris is what, if any, would be the near-term impact here?
So what you're seeing really is volatility into the market, as we mentioned before, which is not a bad thing. Like Masood said, what you need here is a correction. And we got that in the Dow. A correction really is a 10% move from the peak high to the peak low. And we saw that in the Dow from the 29th of January till this morning's low, and we actually had it yesterday as well as the intraday low. So that's a healthy move. It's going to wash out a little bit of this investor euphoria, and what we're going to have is people looking at stocks for what they are. What is the stock? How are they making money? What's the volumes like? And do I want to be involved at this price point or not? And I think that's going to be credible because right now we're in the middle of Q1 earnings. You had about half the S&P 500 report. We're beating on that level from last year, and with these tax reforms I mentioned before, there could be some significant impact for stocks, especially from the bottom line, as those that free cash flow flows through to the economy.
Okay, Masood, my question for you next is, let's look at the corporate view. So if I'm an investor relations officer, what challenges would I be facing sort of in the near and long term, given some of the volatile sessions that we've seen?
So challenges and opportunities. Challenges, it's a volatile market. Investors are getting nervous. For investor relation officers, it's business as usual. Stocks are becoming cheaper. So from an opportunity standpoint, it's a good time to reach out to some of the sideline value investors who've been waiting for a a little correction here. So reach out to them and sell the corporate equity story. We're moving from what's called the deal maker's economy, in which returns have been juiced up by share buybacks and M&A, to a more healthy corporate growth and risk taking. So investor relation officers need to focus on where the growth comes from, what their equity story is, and how they are going to grow the business.
Okay, my final question to both of you is volatility back in vogue? Chris, what do you think?
Absolutely. I mean, it's been long overdue. A correction has been way long overdue. And I think you need this yin and yang, seeking alpha, whatever you want to call it, in the markets to actually capture that back and forth. And what is good for that is it brings traders to the table.
Got it. Masood, your final take?
And let me add to that, with respect to going back to 2003, 1 month after the Bush tax cuts, we saw Treasury yields rise from about 3.1% to 4.6%, excuse me. Currently, we're seeing the 10-year and the 30-year pierce to 2.5 and 3% respectively. So small moves, and within that 6-week time span in 2003, markets went down about 5%. So expect more turbulence. However, just like 2003, we saw growth in the equity markets for a good 2-3 years after that. So the long-term perspective is strong, the economy is strong, and we should see the bulls come back into the equity markets eventually over time.
All right, well, gentlemen, we'll leave it there. Thank you so much for joining us on a special edition of Advisory Live on the market sell-off. I appreciate your take. Thank you very much for your insight. And to all of our viewers tuning in, be sure to stick here at Nasdaq live on Twitter. We're going to be bringing you routine and regular updates throughout the day on what's happening on today's session. So be sure to keep in touch. And if you have questions, tag those to us right here at Twitter at Nasdaq. And for further information about our IR solutions, be sure to visit our website. That's at business.nasdaq.com. I want to thank Chris Dearborn and Masood Ghazi for joining me on today's Advisory Live. Thank you so much, gentlemen.
Thanks for having us.
And thanks for tuning in. Thank you.